This is episode 251 of Zen and the Art of Real Estate Investing with my guest, Mark Khuri. Mark is the co-founder of SMK Capital Management. He has over 20 years of real estate investing experience, started in 2005. I know, we've been in this a while. I've been in it longer. He started in California and Florida doing residential real estate investments. Now at SMK, they've invested in well over 50 commercial real estate opportunities across numerous asset classes, which we're going to talk about, but they involve mobile home parks, self-storage facilities, multifamily, retail shopping centers, oil wells, student housing, vacant land, short-term debt, and niche sectors. Mark, welcome to the show.
Thanks for having me, Jonathan.
Yeah, it's good to get you on. And you guys are really a diversified opportunist of an agency because you're doing syndication, but you're looking at a lot of different asset classes. Tell the listeners why and why it makes sense for what you do at SMK.
Yeah. So, it's been a big foundation of our investment thesis since day one, Jonathan, diversifying. Where did it come from? I mean, for us, I think probably a lot of the thought process was around reducing risk.
Yeah.
Spreading capital, right? Multiple asset classes, operating partners, geographies, strategies. Because we started our firm, really right around the recession of 2008 and 9. And the world was falling apart and everyone was trying to reduce risk while still earning an attractive return. And so that's still been with us since day one as far as diversification and how we continue to think today.
Yeah. And I guess starting at that time, you look back at what just had happened and what was still happening, thinking like, hey, well, if we're going to build this into the future, what are people scared of? Losing all their money.
Of course.
Yeah. Yeah. I mean, why did you decide to start then? I mean, it seems like a time when definitely there's opportunities out there, but you just gone through something where so many people lost it in 2008.
Sure. Yeah. So, I started investing in real estate in 2005. So kind of before or during the upswing, depending on location, of course. And then at the time, Jonathan, I was working full-time W-2. I was a financial analyst for Raytheon Company for a number of years. And in real estate investing was, on the side. My father's a mentor of mine. He's been an investor since the 1970s. And so I got my start, in my mid-20s, let's call it, right?
Yeah.
And of course, 2008 and 9 hit. But what we had been doing while working in the W-2 is my family and I had been partnering together, pooling our own capital, buying properties. Most everything we were buying was heavier value add, distressed properties, foreclosures, the courthouse steps, REOs, short sales, boarded up houses, duplexes, fourplexes, and just, rolling up your sleeves and getting into it and creating the value manually. And we built a small portfolio of properties in a few states through that time period using family capital. And then by, 2009, I'd left the corporate world and really wanted to go full time into the real estate investment business. So that's when my father and I partnered and formed our firm, SMK Capital Management, to really just kind of expand on what we had been doing as a family.
What I found from other people who do funds, it's so interesting that diversification, a lot of people just think, oh, asset class, geography, super important, operators, super important. The timeline is really important. And I don't think that your regular new investor who's not savvy on passive investing understands how diversified you can actually get inside a fund. So talk about that a little and those other demographics and things that you're working in.
Yeah, absolutely. The details and the nuance and the niche asset classes, I'll put them together in a fund. It's a lot of work. It's much harder to create than, of course, a single asset investment. But there's benefits there for everybody involved. But some of the nuance and some of the things that make it a little bit different. We like to look at income and growth, and we have in some of our recent funds, and the current one that we're building as we speak, soon to launch, is fixed income as a portion of the portfolio allocation. And so that just helps increase yield, day one to investors. In conjunction with, kind of a little bit more of a blended income approach with growth. And so maybe we'll take that 250 unit apartment community that we described, assuming it meets our investment criteria, and give it a slice of an allocation in our fund. And then we'll also potentially put in a private debt fund that's already producing, 9, 10, 11% in yield.
Right.
And then also look at some more value add strategy and potentially some growth strategy. And so what that does for an investor, if you think about their capital being put to work, usually in year one, they're able to achieve cash flow. Usually we're trying to target, 3 to 5% at least in the first year net to
Yeah.
investors. And then we look to see that growing over the next few years. And then we like to try and return capital, a portion of it, right? So from the debt funds, they're usually shorter investment durations. We can redeem our interests and return principal back to investors in year, maybe 3 or so.
Yeah.
And so that anytime you're in an investment and you're getting your principal back, you're reducing risk right off the board. You could take that money and put it in something else, the next day if you choose.
Yeah.
And that allows you to compound your return over time. If you continue to do that, you'll obviously generate, very attractive returns. And so that's part of the life cycle. By year 5 or so, we're typically returning a good chunk of capital from property sales, refinances, and redemptions. And so we like to see that there's still ownership in assets continuing to produce yield, even though we've returned, a portion of maybe even all of the capital principal to investors.
So we talked about a couple different asset classes, but geographically, how do you like to diversify? Are there any areas that you guys are staying out of, or is it still asset class specific?
Yeah, there's definitely some areas we typically stay out of. The Northeast is one, the West Coast and the coasts in general, although the Carolinas and parts of Florida are still attractive to us.
Yeah.
But we look for properties that we can invest into that are positively leveraged, producing positive cash flow day one. So if you acquire it and the next day something catastrophic happens in the economy or et cetera, the property should still be producing positive cash flow without having too much execution risk, where our sponsors and operating partners will have to come in and, add value in order to be able to create that cash flow. So we would consider that more of a growth investment.
Yeah.
But most of our bread and butter, Jonathan, is producing cash flow, first day, first year of the investment. And those opportunities typically lie in the Midwest, the South, Southeast, Sunbelt region, of course, where you have call it a higher rent to price ratio than you would potentially the Northeast or the coasts.
How do you try to figure out what's possible? I know it's staying diversified, but the tariffs could affect all asset classes, in some way.
Yeah, they could. I don't think anybody knows yet the extent, Jonathan, or how and when. So it's a little bit of a wait and see approach, but also try and, speak to our sponsors and operators in a very more specific subject matter as to, vintage, CapEx, different maintenance, where are these materials coming from? And we've already seen prices skyrocket in the last few years, right? And so some of that inflation expense increase that we've experienced is currently baked into current New Deal numbers.
Yeah, I agree.
But be a little more conservative, right? Add more padding, put in a little bit more contingency, be safer about it. And just timely as what you mentioned, one of the investments that we are targeting for our new fund, I was chatting with our operating partners just yesterday about it. And this is in the triple net industrial sale leaseback space. One of their targeted investments is into a manufacturing business in the US that's been around for 130 years. They went through the Great Depression. They've been through, anything and everything you and I probably can recall and a lot more. And so this business has been around for many, many years, but they produce basketball courts is one of their products. So they produce the flooring for the NBA, for a lot of different universities across the country. They've got 6 properties in multiple states. And so you look at this, you say, okay, well, how do you analyze the risk of their supply chain and where they're sourcing materials? And, one of the things to take away from the conversation is they are using a specific type of wood that is sourced in in America, in the US, in the forest right near their main headquarters.
Yeah.
And so they're not bringing in lumber from Canada, for example. So a lot less potential risk on their supply chain for building this one specific type of product. And so that's
Yeah.
just an example of some of the conversations we're having regularly to try and see how to mitigate against the tariff risk.